So my name is Erik, I work for BearingPoint. I have about 20 years of banking experience. I've been with HSBC, RBS in London, Nordea in Copenhagen, and Danske Bank in Sweden and Finland. Then I have done a startup, through tech startup. I quit banking and I moved into my garage, just me and a desk and I. And then now I'm a consultant. I spent 2 years at BearingPoint and I focus on banks.
Thank you. I have some 30 years of experience in banking in different positions, banking, asset management, capital markets, insurance. The recent position I held was that of a CEO of Aktia Bank, the third largest Finnish bank, and now I have been working with BearingPoint on this project looking at Nordic banking and how would it look like or how should it look like 10 years going forward. But let's start with big techs and banking and big techs and essentially then disruption. Now if we look at big techs compared to fintechs, I think there are a few differentiating factors. The one big differentiating factor is that big techs have capital, capacity and credibility, and fintechs lack these. At least there are very few carrying all of these, and many lack even one of these. In some areas globally, big techs actually carry more credibility and reliability than the local banks or the local banking system. So the approach is very different for fintechs compared to fintechs. There is also the difference that big techs really don't need to partner up with banks. If they want to do something, they are able and capable of doing it on its own. What we have seen of fintechs, and we can come back to that shortly, is that they have a tendency to partner up with banks in order to pursue their innovation or their idea. There's also a difference between big techs and banks, a very fundamental difference. If we look at big techs and what they are kind of set off to do, it is to make your life easier or to make your life more exciting. If you think of banks, what banks are set off to do is to safeguard money, either your money or their own money. And the angle of approach is very different, making life easier or exciting or safeguarding. So the narrative and the approach to people will be quite different. Now, big techs could disrupt a bigger totality in banking than what fintechs can do or have done. Typically, fintechs come and take some corner or some slice, bring their own innovation, and then either succeed or they don't succeed. If big techs wanted, they would be able to take bigger chunks and change that. But I think the emphasis here is if they wanted. So far, they really have not wanted to do so. I think there are many reasons, but one reason probably is that at the time of zero interest rates and negative interest rates, the attractiveness of banking was quite different from what it is when interest rates are positive like today. They simply got a better return on equity on different venues and different paths they chose. Now it's interesting to see, does this change as interest rates are clearly positive and apparently will remain also on the positive side. But if we look at the Nordic market, big techs will not start disrupting banking in the Nordics. If we think of the Nordic banking market, Nordic banks are quite digital. They began digitalizing themselves before the word even existed as we understand it. And the services that Nordic banks provide they're good. I mean, they might not be excellent, but they are good enough. If you think of your online banking or your mobile banking, I guess you can pretty easily take care of most of the tasks that you want to take. Now, if we think globally of people, about 3/4 of the people on this planet are unbanked or underbanked. And then we are typically looking at regions like Asia, emerging Asia, perhaps South America, Africa. Generally speaking, regions where banking penetration is low and mobile penetration is high. That would be the area where big techs, if they were to enter banking, would start. USA, I think, in my opinion, is a test lab to sort of test and roll out and see how their thoughts and their concepts might work. But the real penetration is there where mobile penetration, or sort of real breakthrough is where mobile penetration is high and banking penetration is low. And that will not be Nordics. Obviously, eventually there will be a spillover. I think that the big question is, and I don't have an answer to it, is this a winner takes it all sort of competition? Will there be a super app that is going to get all the market or most of the market. I think there's a fair chance that it could be so, because if we think of other applications, there tends to be one clear leader. I mean, it's not that or there probably are multiple Facebook type of applications, but it is a sort of, one platform that has captured most of the business. And this could be the case in banking also. But if we look at now going to disruption, because this would eventually be then some sort of disruption, and going back in time 5-10 years, there was a lot of talk of disruption and how banks need to become a tech company, and essentially they're going to lose the game because garage type of, guys and girls are going to just break it and take it. That did not happen. I think there are a handful of reasons why that did not happen. Firstly, banking is complicated and banking is very conservative. It might sound simple that, okay, we take money and we give out loans and we do some investment products and whatever. But when you really go down to it, it is very complicated and conservative, not only because of regulation, but also because of regulation. Secondly, banks did step up. They didn't give up the fight. They stepped up in two ways. First of all, they stepped up their own development to sort of improve the customer parts and the customer experience. And the other way they stepped up is that they really mobilized a battalion of lawyers and compliance officers to go back to fintechs and say that what you are doing is not in line with regulation and it is illegal. And the poor fintechs with 10 people or 20 people with these battalions of compliance and lawyers, it's really an uneven game. So banks had an upper hand also in challenging what fintechs were doing or are doing. And like said, it became economically more feasible for fintechs to team up with banks so that they became kind of outsourced IT departments or outsourced test labs. It was essentially a win-win, or is essentially a win-win situation for both parties. And finally, like said, at least up until so far, big techs did not enter the market. Maybe now with positive interest rates, the sort of the logic of banking business is back to normal again. Let's see what happens if they do want to come. And finally, then if we think of different markets, and even if we think of Nordic markets, the markets are quite different. So it is not that you disrupt something and you get the Nordic region. You essentially need to disrupt 4 different markets, because there are very few areas in banking, even in the Nordics, where you can have a sort of one solution that's going to fit all the countries or all the customer segments. I think if we are going to see, or if and when we are going to see disruption, it will be in high volume, low complexity products. And then we are looking at payments transactions or payments transfers, and for example, non-collateralized lending. Because non-collateralized lending essentially is just mathematics and sort of assigning probabilities. When you go to collateralized lending, corporate lending and the like, it becomes tricky to disrupt it. And if you think of business areas like corporate finance, well, what is there to disrupt? There are people in the suits with red socks are going around town and they are having lunches and dinners, and that's corporate finance. We don't have red socks now. We are just on the stage as presenting to you. But it would be in high volume, simple complexity products.
Yes. Should we swap places?
Yes, let's do that.
I can see what do you see behind me. So now we have outlined our thinking of big techs and their possibilities to interrupt or disrupt. Now that's about the future then. So what will happen? The question is, what are you going to do now, given that? Well, that's one thing that can happen. It can also be that some small fintechs revolutionize something, some parts of it, but you don't know what part. It can be that some other bank come up with some brilliant idea. So what you can be sure about is that you can't be sure what game you're going to play 10 years from now. But you still have to deploy the budget now. That's a little bit the same as if you are stepping in. I told the first row here, like the 6 of you, that you will compete next year. It will be either football, volleyball, sailing, or boxing. What are you going to do then with this year of training? Are you going to go all in boxing and win that and be a brutal loser if not? Probably not. You're going to prepare for all of it. You will build a strong core. You will practice balance. You will eat well. You will sleep well. You don't smoke. You make sure you can compete in any of them. And that's the same for banks. You cannot put your eggs in one basket. So that is what Mikko and I have been thinking a bit about in the last few months. So when Mikko stepped down as CEO of Axia, we were so lucky that I called Mikko and I hired him. So that because it's not that often that you can hire someone with 30 years experience, 5 years CEO of a bank, and you get him to work on your team on thinking about stuff. That's usually not what you get to do. But we had that chance. So what we have done is that we have written a white paper. It will come out in a few weeks, where we look at what should you do now, given that future is uncertain. Will this happen, or will something else happen? The problem is when you're decision-making, often, like I was head of FX at Danske, I had a sales team of 150 guys. Mikko has even been CEO of a whole bank. You rise to this position because you're good. In my case, I was a good FX sales guy, so I became head of FX. Suddenly, I was asked IT questions. The same happens with Mikko. He was great, so he became CEO, and now he has to make IT decisions. And you're up against people that have spent their whole careers in IT, and they outsmart you with very complicated questions, and you have 200 of them, all saying that if they don't get the budget, everything will die. And you're gonna, okay, that sounds bad. We don't want it to die, so you have to give it to all of them, but you can't. The problem is also that your budget is first whatever something, 100. 45 of the 100 will go into lights-on projects. You have to do it, otherwise everything stops. Then you take another 45, and that goes to regulation. Somebody says there's a new regulation, you have to report. Okay, you do that. You're actually only left with like 10, 20% of the budget for true new things. So even if the banks have massive budgets, the stuff that can be deployed for things that are forward-looking and changing things are usually a lot lower. So you have to be really clever about that. And that is what we then, in the next slide, if I push here. If you have to choose of these 200 things, direct the decision in these 5 areas. So get your data and processes in order, because if you don't, you will report things wrong, and there will be no good AI 10 years from now. Get data right. 2, rethink IT. That's happening now. A lot of banks are reorganizing IT. Traditionally, you would have IT meeting only at the CEO level. Keep IT, through IT, just running the printers, but then integrate IT with the business. It's happening some places. It should happen in more places. Otherwise, it will be hard to keep up pace. So rethink how you organize IT, because banking is becoming IT. 3, incentivize management properly. One of the problems is that any true transformational bet is going to take like 7 years. It will be loss-making year 1, 2, 3, 4, and then boom, you're sacked for low performance. So you will never be there to see the benefits. You need a culture and incentive structures in place to be able to take the long-term transformative bets. 4, you need to dare to greenfield. Start over. Instead of building on what you have, start anew, migrate, make sure you allow no connectivity back to the old, and then kill the old. Otherwise, you will be stuck with this eternal legacy. If you look at, for example, music, there were cassettes. Well, like when I was young, there were cassettes. I'm 49, so I had cassettes. Then there were CDs. CDs were there for 10 years. Then somebody said, no, we will stream to a little thing called an iPod. And they were there for 10 years, and then somebody said, no, we will stream, and it's Spotify. 4 times the music industry had let go completely of all technical legacy and started over. Banks have not. They have super well-developed tape recorders from 1962. I have worked for banks for 20 years, so I can make fun of them. So start over. You can start over everything, and that's a massive risk, but you can also start over some of the things. But try to kill off your legacy. And number 5, be ESG ready. When we speak to people out there, ESG is a mega trend. Basically, most of us believe the planet is burning. It's going to have to be rescued. And banks' role in that is misunderstood widely. Basically, what the politicians have to do is to find a way to channel capital towards things that are good and away from things from what are bad. And the mechanism for that will be a marketplace. Banks run marketplaces. So that will be the mechanism that society will use to channel capital and by price signals, not by do-gooding. You can think whatever you want of it, but as long as you act in accordance with what's right, because the price is for it, you will still do the same good even if you hate it. And the banks will be, we believe, used for that. That has to be invested in for that to work. Now the question then is ESG a new business opportunity? Some people say, yeah, it is a massive business opportunity. Other people simply say, no. All products will be killed and green versions will come. So the pie will remain the same. In either case, you have to invest in ESG. Because if all products will be green and you have no green, you're just dead. And if it actually grows, or if it will add new market share, then you want to be competing for that. In any case, invest in ESG. So, fix data, rethink IT, get incentives right, dare to greenfield, and invest in ESG. That's what we think makes sense, given that you, in the kind of positions that we have to choose between hundreds of things that are all seemingly life or death matters. That is what we had. We have a beautiful slide here with BearingPoint.
And if I'm to add what Erik asked me in spring or early summer, he said, okay, come on, tell me now, why is it that bank managers or bank leaders or C-level managers at banks don't do what they should do? It is so obvious what they should do. Tell me now, why don't they do it? And I told Erik, well, I think the situation is a bit the same like in the sovereign bond crisis or in the European sovereign crisis in 2011, 2012. Ministers of finance say that, okay, we all know how to solve the crisis. We don't know how to win the election after that. And I say that the challenge is not to know what you should do, but the challenge is that you need to manage with the owners, with the investors, in the boardroom, and with analysts. And that makes the equation tricky because at the same time, the bank needs to be investable. And essentially, the bank should need to turn into an IT company. But if you think from an equity investor point of view, an IT company investment and a bank is quite different. A bank is expected to pay a stable dividend flow and run a low-risk business. And you can't really go and say that, okay, forget dividends for 4 years, we're going to do something, build really exciting, come back in year 6, 7, completely transformed, future-proof, and just bear with us. And it is not a bank. A bank cannot do that. And then even further, if you think that an average time in office for a C-level manager is about, say, 5 years, a board member is also 5 years, roughly, which means that in about 2-3 years, half of the people are new. And then the question will come on the table that, okay, so what exactly are we doing? And could somebody remind me, why are we doing this? And this is actually quite expensive, so how much is it still going to take money? And it becomes, a bit challenging to run long-arching projects. This is obviously is not only for banking, but generally speaking. So the vision needs to be really strong. And it is difficult to come with a really strong vision from an industry that is essentially expected to do more of the same.
Okay.
And maybe we wrap it here.